folks, hope you're all well and welcome to the next series of videos I have planned for my education playlists. For those who know me, this series is entirely predictable and probably the only surprise is this isn't the one that I put together first, given that I'm very much focused on risk and risk management above most other things. So that's going to be our focus for the next few weeks as I provide my thoughts on both why it's so important and how you may want to think about putting a plan together and putting that into practice for yourselves. I'm aware that risk isn't the most glamorous of subjects and the subject matter can become a little dry as a result, but I firmly believe that these details separate the long-term traders from the 80% of people who end up leaving the industry, and it's something that every aspiring trader should learn and implement above all else, in my opinion. The series agenda is on the screen at the minute, and I plan to try and keep it as bite-sized as possible given the subject matter, so I'm going to cut this down into smaller chunks of hopefully a maximum of 10 to 15 minutes per video. Some might even be a little shorter than that, but we'll see how the timing goes once I actually start recording the material. So today we're going to start with the why. Why is risk management so important? And to emphasise that, we'll look at the numbers behind risk management and what happens specifically if you don't have a controlled risk management plan that you stick to try and bring that to life a little and let you see what an account drawdown would look like in various different scenarios and why you would want to manage that as best you can to avoid certain scenarios. So with that said then, our goals for today are fairly straightforward. I want people to go away with an understanding of why risk management is so important, an understanding of the numbers behind that why, an understanding of a few different methods or potential methods for how you might want to use risk scaling as a concept if that's something you've not seen before. I look at how recovery looks after you've suffered from account drawdown, which, as we'll touch on, is something that everyone will suffer from at one stage in time, and why you might want to control that drawdown as best as possible for recovery reasons. And then a quick look at risk modelers and an idea on how you might want to build your own risk modeler so that you can know what your numbers are at any given time. Before we jump into the actual detail and have a look at the numbers, I wanted to cover just a few kind of logistics details about risk and risk management, and I've put a few kind of key points around that on the screen. So there are many kind of components of risk management that you might consider to be standard or fundamental or universal to everyone, and that is true to an extent. You would, most or all risk plans would have a maximum percentage per trade, that kind of thing as an example. What that percentage is going to differ depending on the person and what their risk appetite is, what their outlook is, all that kind of stuff that you would call individual to each trader. So overall, a working and tested risk management plan is going to be individual to you as a trader. There will be components that will be similar, but really what you need to think about is what fits you, your mindset and your trading practice. So we'll cover a lot of things in these sessions that pertain to risk, but keep in mind throughout that this is very much how I do it personally. This is what works for me, it's what I've tested over time, it's what fits my risk appetite. You don't have to copy or take away this exactly, it's just to try and make you think about what you might want to put in yours and how you might want to adapt that to fit your mindset and how you want to approach being a trader, and then go away and test that and see if it works for you. There is no one size fits all cookie cutter way to define your risk management plan. I can't give you a plan and say fill this in and that's it. There would be common components of it. As I mentioned, the maximum percentage risk per trade, for example. Some people may have their maximum drawdown on a daily basis in it. Others may have how they're going to use leverage in there. There would be your position size and math would be defined in there. But these are things that might be similar, might be the same, might be different. So it's going to depend on you as an individual. So just think of this series as ideas for you to think about, things that you would take away and look to put in your plan as you're developing it. And the one thing I would say that is universal, and based on my intro, this is not going to surprise anybody, if you don't have a risk management plan that's at the forefront of your thinking, then you need one for longevity in markets. If you plan to be trading, and it doesn't matter what instrument or what market or what asset class that is that you plan to trade on, if you want to have longevity, you need a risk management plan and you need to stick to it. in my opinion. So that's the kind of logistic stuff out the way. This is very much my approach. Hopefully it gives you something to think about. Let's jump into the detail then. So why is risk management so important, or why do I think risk management is so important? And the first thing, I think this is I've put this right at the start because it's something that particularly new traders coming into the market struggle with. Whether that be looking for the perfect trade plan, or looking for the thing that's going to make you win every single time, and having that mindset where you can't be wrong, you need to figure it out, you need to be right every single time, and if you're not right every single time, then you're doing something wrong. And that in trading just patently isn't the case. You are going to be wrong in trade ideas. There is no single 100% accurate trading or investing system. It's very much a game of probabilities, and what we're looking for is edge. And edge is something we'll touch on in later sessions, but that edge essentially gives us a higher probability that the market's going to move in the direction that we think it's going to move, but that's still just probability. Even the best traders, be that on an intraday level or a position level, their win rates are not 100%. I'm sure I read a study at some point recently that the kind of top 1% of retail intraday traders, their win rate was somewhere between 50 and 60%, and that's top 1%, so everybody else is obviously lower than that. But win rate isn't the thing that makes you profitable over time. The trading system, your psychology, and your risk management is what makes you profitable over time, because it's not about any single trade, it's about the series of trades, and that's something we'll speak about a lot. So you will be wrong in trade ideas. There's no 100% accurate system for trading, so you need to control that drawdown, because you will have periods of drawdown. You need capital to be able to trade and to be able to profit over time, so protecting your account with appropriate managed risk is paramount. And you should really think of risk management as your insurance against being wrong, the thing that makes it okay for you to be wrong, and that's something you need to get into your mindset, is you need to make it okay for you to be wrong. It's something that a trader who's close to me says all the time, and it's great advice, that you need to make it okay to be wrong. It's very much a big game of maths in terms of the probability, and making sure that you can control your positions over the series of hundreds of trades to make sure that your losses lose less than your winners win, and that's how you grow an account over time. So why is risk management so important? It's because you will be wrong. There's no way in this game not to be wrong, and in order to make sure that being wrong doesn't hurt you too much, you need to be able to control the outcome of that. And the way we do that is by making our losses consistent, and we make our losses consistent via risk management and position sizing. So that's the why it's so important. And we're going to have a look at the next few slides at the numbers behind that, because that kind of makes it come to life a little bit more in terms of that why. And I think when people see these numbers, I've done this a few times, and when people see these numbers, they can be genuinely quite surprised at them. So let's jump in and look at those, and that'll kind of bring this to life for you a bit as to why it's so important. This then is an example drawdown plotter that I've put together in Excel, and it's something that I use a lot in terms of managing my own plans and keeping myself right from a drawdown perspective. So there's a lot of columns here. We'll talk through the columns in order, but the general premise of this is we want to look and see what our account drawdown would be after a series of 10 losing trades. Some people might say, well, it's unlikely you're going to get 10 losing trades in a row. My question to that is always why? Why is it unlikely you're going to get 10 losing trades in a row? It's entirely possible that you can, and we're not saying that you're definitely going to get 10 losing trades in a row here. We're just using this as a projection to see where we would be in that scenario. You can pick 5 or 6 or 7 in this list if you want to look at that and look at the drawdown against it. The point still remains, regardless of how you look across these columns, that controlling your risk and a consistent controlled risk is beneficial to you in terms of that drawdown. So the first two columns is a 10% per trade risk. So you can see the drawdown there after 10 trades of a 10% system. So your total loss would be $6,513 on a $10,000 account. We'll use a $10,000 account just as an example, which is 65% there or thereabouts of your account you would lose after 10 losing trades, leaving you with 34% of your account. Now again, some of the questions I've had in other sessions that I've done this is who's risking 10% per trade, and the answer to that is more people than you think, and a lot of people are risking more than that, and risking more than that without even realising that they're risking more than that. And it's something we'll get into later in the sessions around about leverage and responsible use of leverage. But think about this, ask yourself this question: have you or anybody that you've ever traded with done this? So if you go into a position with half of your account, and your trade stop loss is 4%, which is a reasonable kind of level for a trade stop on a swing trade, but you decide you're going to go into that with 10x leverage, you just pick 10x, then the trade risk there actually becomes 40%, and because you've gone in with half your account risk in that single trade is 20%, because of your use of leverage and not having done the maths to figure out what that means. So there's one example where somebody would be higher than 10% in a trade. And personally, I know of many people who go further than that. They would go into a leverage trade on their full account with that same 4% stop, but they pick 20x, and that, when you look at it and do the maths on it, is an 80% account risk on a single trade, which is insane for the kind of numbers of it. But we're not getting into that today. That's for the leverage session, but that's why leverage casinos win. The house always wins when it comes to leverage if you don't use it responsibly. But that would be my answer to that. I mean, 10% is a high number, but there are people who genuinely do go in with that or higher. So this kind of shows your drawdown numbers if you take that approach. Now, conventional risk and risk management logic would say that the maximum you should be risking per trade for any individual trade is 1 to 2% of your account. So that's the numbers I want to concentrate on in terms of the difference between that, and then we'll have a look at the sliding scale of risk as well. So if you look at that on a flat 2%, the drawdown in that, you can see that it's quite the difference. So after 10 losing trades, you're 18% of your account, leaving you 81%. So there's quite the difference on the 2%. The 1%, as you would imagine, is half of that again. It leaves you with a 9% drawdown after 10 losing trades, and 90% of your account still left to recover. And if you look at a sliding scale, so when I talk about sliding scale, this is the risk management implementation that I use personally. So I start at 2%. If I suffer a losing trade, then my next trade drops to 1% until I've recovered that initial loss. If I suffer a second loss, I drop to 0.5% until I've recovered that second loss with the 1%. And I stay at 0.5% until I've recovered the initial losses. And overall, on a series of 10 losing trades, that leaves you just under 7% down, and leaves you about 93% of your account. So it's just a way of managing the risk for me and being consistent and scaling back up again once the original loss is mitigated. And the thinking behind that for me is that in periods of extended drawdown, where you're not on it on any given week or any given month, it just limits your account loss against that period of drawdown. So you can see there's quite a difference there between 65% the 10% per trade, and the 7% or just under 7% using the sliding scale, and the amount of capital you have left in order to profit on is massive. So that's the maths behind it. And I'll say again, the maths in this, in terms of how we manage risk in markets, if we don't do it properly, then the math is not our friend. It's not something that's on our side and is going to help us if we just kind of let it run away. That's how particularly the leverage casinos are built in terms of their profitability. It's designed not to be on our side, so we really need to control it so that we know where we're at. And moving that on again in terms of what the recovery looks like, and this is why it's important. So if you look at it's the same notional 10k account that we talked about a second ago, though the dollar figure doesn't really matter because we work in percents, and you should always really be working in percents in terms of your risk and your profits and your stops and that kind of thing. Working in percent just makes it easier, and it makes your system scalable regardless of how much capital you've got you've got behind it. So if you look at the kind of top right hand table there, the recover to break even numbers are laid out there for the 4 different scenarios that we spoke about. So the flat 10% down to the sliding from 2%. And if you look at the break even recovery for that 10% after a 10 trade drawdown or 10 consecutive losses, you need to essentially 3x your account just to get back to break even in that scenario if you've not controlled your losses and your 10% per trade. So 187%. Give or take is what you need to make, so essentially 3x your account. At 2%, it's obviously much better. It's only 22% to get you back to where you back to break even after the 10 trades. At 1%, you're only just under 11% you need to get back to the break even point. And if you're using that sliding scale, then you only need to make just over 7% on your account to get back to break even. So the numbers there kind of hammer home why that risk management is so important. The second table on the left is just a kind of a high level example of the different account losses that you suffer and how much you actually need to then break even from that. And this is kind of noddy maths type stuff, but it's the stuff that a lot of people never really look at or never really take into consideration. So if you look at the lower end of that, if you've lost 70% of your account, you need to make 233% to make it back. If you lose 80%, you need to make 400% to make it back, 90%, 900% to make it back. You're in the realms of Rechtsville and never coming back for those sorts of loss levels, which is why you really want to manage your risk as best as possible to make sure that whenever you do go through periods of drawdown, your overall account loss is limited to ideally the top 2 boxes there at 10 to 20% as best as you possibly can, because that's recoverable at that stage over the preceding weeks and months if you're using that controlled position size and risk management model. And again, I say at the bottom there, the maths is not really on our side if we don't manage risk appropriately, if we just let the trades run away and don't know how much we're willing to lose before we go in and lose random amounts and lose big chunks of our account. Getting that back is very, very difficult, and without the capital you can't trade. So managing your capital again is the key for me. We should be risk managers first and traders second. It's not all bad news though. I've been intentionally harsh on the risk side of things in terms of trying to hammer home that point and make it obvious why we want to manage risk, or why you want to be thinking about managing risk and how you put together and implement your risk management plan. But if we do manage that risk appropriately and we understand the numbers, then we can control account growth over the longer periods of time. So again, over the series of 100 or 1,000 or however many trades it is we want to get to, making that single trade irrelevant and growing an account and growing your capital over time. So if we can consistently manage risk at that account level rather than the individual trade level to protect our capital, our profit multiples across a series of trades don't need to be crazy big in order to make a good return over time. So the bottom table on the right hand side there is my risk grid in terms of break even calculations at different risk reward levels per trade. Now the target trades that I look for are 1 to 2 or above, so I know based on my back tested systems if a model I'm looking at is going to be 1 to 2 or above in historic data, and I know at 1 to 2 that I only actually need to be right 34% of the time to make profit, just above break even, but it's still making profit if I'm right 34% of the time. So if I'm back testing a system that shows that I'm right 45 to 48% of the time, then I know over the series of trades and over time that strategy is going to be profitable, and I can have confidence going into the trading that strategy, that if I'm consistent with my risk and my position size, that a losing trade doesn't matter, because I know for the data that over 100 trades that's going to return X%, or the expectation is that's going to return the X% of profit. And you can track that expectation against reality and tweak that over time to optimize. But in terms of calculating how much you need to make on any given back-tested system that provides a kind of optimal risk reward based on how you've tested it, you can see where you need to be in terms of the break-even calculation. So for me, 1 to 2 is kind of the minimum that I look for. Sometimes I'll use 1 to 1.8, but anything below that I don't really consider for myself. And one of the things I want to touch on, that I kind of touched on it in the first point there, but I didn't explain what I meant by it. And it's something that, again, new traders find it difficult to understand, is that there's two risks that we talk about when we talk about trading. There's the actual trade risk itself, the individual trade risk, and then there's the account risk based on that trade. And these are not the same things. So, if, for example, your risk management plan says that your maximum trade, or your maximum account risk per trade is 2% of your account, but you look at the trade and the stop loss location calls for 4% of that trade. The location on the chart technically where you're wrong is at 4%. You don't just arbitrarily move that to 2% because your account risk is 2%. You use position sizing to make that 4% trade risk a 2% account risk, and I picked those numbers as an example because it's easy maths to do. So basically you'd be a 50% position size, you'd be half your account would be a position size on that, because if your trade risk is 4% and you go in with half your account, then that's a 2% account risk, and that's how it works. We'll touch on the position size and maths in a later video, but I wanted to get that point across. There are two separate risks you need to consider. There's the individual trade risk and how you're going to manage that trade based on technicals, and then there's the account risk and how much you're going to risk of your account in any given trade and how you make the two match. That's where the consistency comes from, how you make the two match over your series of trades. So again, the risk grid there kind of shows what I'm kind of talking about in terms of the numbers. So the top right hand side there is my risk grid for trades 1 in 10 to kind of show you or show me, it keeps me honest, where it's 10 trades, 5 trades, 4 trades. It's just a grid that I can refer to see where I need to be in order for profit to work out. And as you can see, if you look at that series of 10 trades, so the top table there, and you look at the RR of 2, if you're right 50% of the time, if you can get to a point where you're right 50% of the time, you make 10% of your account over 10 trades. It doesn't matter how many times you're wrong. You're wrong half the time, but you're still making 10%. That's because we're controlling the risk. So I'm only losing 1R for every 2R that I win in a 2-to-1 trade, and it's consistent. It's consistent against my account. That 1R always equals 2% of the account in the scenario that we're talking about in a moment, and the 2R always equals 4% of the account. So essentially, every winner wins twice as much as every loser loses, because it's consistent and it's applied consistently. And again, that's how you make individual trades not matter. If you lose an individual trade but you followed your strategy rules and you followed your risk plan, that was a good trade. Your idea was wrong, but that's going to happen. Your idea is going to be wrong. As long as you followed your rules and you followed your risk plan, you know over the series of trades that's going to return you positive results. And that's us for the day in terms of the content. It was just really to get across those numbers to you. When I have this conversation with people, particularly new traders, the numbers can surprise them, and it can be quite daunting to see it laid bare in that fashion in terms of how the losses can rack up, how your drawdown can rack up, how the maths of it all works. But ultimately, understanding it is how you then fix it. Is how you go about turning your trading into a consistently risk managed trading plan. And ultimately, that applied account based risk management is key, in my opinion, to longevity in the markets as a trader. This is something that is very much my opinion. So it's not a statistic that I actually have. But just based on the conversations I have with people, we know that 80% of people who enter trading end up failing and moving on. The one thing that the 20% who succeed have in common is that they all manage risk appropriately. Now, that's not to say that the 80% don't manage risk. Some of them will obviously try and manage risk, but it's a thing that, the people who I know certainly that are successful, risk management is something that they do very, very well. Protecting capital should always be your number one priority. Hopefully you can see why now based on the maths, and that maths is not on our side unless we manage it appropriately. Drawdown is a natural part of trading. You're going to be wrong, you need to be okay to be wrong. The key is to try and control that drawdown, limit its impact on your capital and limit its impact on your ability to then be profitable afterwards. You don't want one trade to wipe you out, you don't want 2 trades to wipe you out. You want to make sure that those trades are having a minimal impact when they go wrong, so that you've still got the capital to have positive impact when you get it right. And that last point, again, just it's a similar thing to sum that up, is we won't always win. There's always going to be losses. You need to make that okay, both in your mind and in the maths, so that you can manage those losses when they will occur. And that's it. That's the first video in the risk management series. As I say, I know that it's a bit dry looking at this and looking at numbers and looking at maths, but it is, risk management is the number one thing in my view that makes a successful trader. And your TA can be the best in the world, but if your execution is not, and part of execution is risk management, we'll talk about the other parts in the next video. But if your execution is not, that TA doesn't count for anything really. You need to be able to both see the trades and execute them, and have both the risk management and the psychology on point to manage it when you're wrong, because you will be wrong. And that's the key messages to take away from this session. So hopefully that's been useful. As always, any questions, stick them in the comments or social media or Discord, and I'll try and answer. And until the next video, enjoy the rest of your weekend. Until next time, stay safe. My tea's it. Gotta go.